Hey there everyone, this is Andrew Tehako from TnT Group over on the side here, and today we're bringing you Brian Tehako of TnT Group, George Cavaligos of MF Global, and Tony LaPorta of PowerPoints.net. Brought in these guys. Tony's in from Minnesota and Chicago here today, so we wanted to kind of give you another one-on-one type of trading talk. We're just going to hit on some points about the tax cuts, equity, treasuries, direction on things, and their thoughts on stuff. So you guys want to start talking about the tax cuts and kind of what you think going forward with them?
Well, I mean, I wasn't surprised that they're going to try to push them through. I'm basically surprised, though. I will be surprised if it gets voted and passed on. I don't really understand how we can sit here right now, and as a government could sit there right now and say we need to create these tax cuts. All it's going to do is create, how are we going to pay off this debt that we have? That's my concern. So now we're going to we have a chance to maybe make this money back that we are spending, and instead they're going to go deeper into a hole. It just doesn't make any sense to me. And I just don't really think it's going to, the big picture is how we're going to create growth and create jobs. That's what's going to get us out of this per se problem, which I still don't understand how there's a problem when our stock market's all the way back to pre-2009 areas.
From a technical point of view, I looked at that. I looked at the news, and we had kind of been expecting that news. We were anticipating it, and I did a webcast yesterday saying, well, I feel it's buy the rumor, sell the fact. And I also put out, and I'm a big technician, I'm a big Fibonacci guy, and 61.8% is one of my key levels that I really key on for long-term reversals, shall we say. And from the October 2007 highs to the March 2009 lows, 61.8% in the S&P future was 1234.92. And yesterday morning's high was 1235 even. And we backed off from there, and I wrote my commentary last night. I want to be short, I want to stay short, I want to fight this trend. And I actually, from a technical point of view, I hate jumping in front of the stock market in December because year after year it grinds higher and grinds higher and grinds higher. But
why in December? Why does it do that in December?
I think it's don't sell a
Wouldn't
quiet
you think
market.
it would be the opposite?
I think it's George's don't sell a quiet market.
You would think it would be the opposite, though.
Yeah,
people liquidating or getting out.
users, right? But it's always, the famous Santa Claus rally. It's very common. I don't know the stats on it, but they're pretty consistently bullish for equities in December.
The so-called Santa Claus rally is actually from Christmas to New Year's. It's supposed to be, but I've seen December's, they just grind higher, and you just sometimes you can't get them. You think every day, oh, okay, good one. We're on a good little sell here. Like this morning, Wall Street was up 20 points. Before you know it, it's down 20, and you were just telling me, and they've just squeezed us again. You know what I mean? So, tough trade. December's tough trade.
At what point, I guess, obviously you're fighting the government trying to stay short these equities. At what point and how long will this stuff crumble? Because obviously it is overall bad for the economy with our debt, with things like that, with, all the money we're pumping into stuff. Is there a certain time you guys think, at some point these equities are actually going to fall off a cliff?
Well, I'm going to take a kind of contrary stance to what my friends here have both said. What the government did with these tax cuts and the extension of the unemployment benefits and the cut in the Social Security tax, I think is provide a very powerful economic stimulus. The CBOE put out a study a little while back, and I actually have the chart pointing to the most powerful short-term government fiscal stimuli that they could do. And 3 of the top 5 were just placed into play here. Now this tax cut, these unemployment benefit extensions, they haven't been passed yet. I think once they do get passed, we'll see a further sell-off in the credit markets and the bonds and notes, and a further bounce or a further rally in the equities markets. I'm not saying it's the right thing to do. I agree with Brian in terms of the deficit, but one step at a time. I think, is the way the government process works here. It's
But-
like sausage making again.
Where things are at, though, where the markets are at, aren't things okay? Why do they need to keep creating stimulus if things are okay where they're at, except for the unemployment rate?
They feel that the unemployment rate is the overriding
But
thing.
that's not gonna create jobs.
See,
We're screwed here in this
things-
country. There
things-
are no way. We don't
things
have
are
jobs.
not okay. Things are, I think it was around 2 or
But
3.
the market is saying it's okay. The stock market.
Oh,
when things are at
absolutely.
lows, they're
That's
saying
what.
It's forward.
I think it was 2 or 3 months ago that they did bank stress tests in Europe, and everyone passed, and now everyone's failing. It's all a bunch of bullshit. I mean, it's smoke and mirrors. It's ridiculous. And we're up here. I feel more than anything else to well, my 401k is doing okay. Let's go spend some money on Christmas, and I don't see it. And I agree with you, George. And I'm beginning to think that one of these days we're going to see a good body press and slam lower in the treasuries, and they're going to sell their treasuries and buy stocks, and then that will be the high. That will be in Wall Street.
I can see that.
But I mean, at the moment you can't fight the tape. And I'm trying to fight it up here. I really am. And I mean, I sort of had that funny feeling last week when the shit was hitting the fan in Europe, and Wall Street wouldn't come off. And I said, what, just close your eyes and buy this stuff. And I kind of was right, but I don't want to be long. But when the market doesn't do what it's supposed to be doing, you sometimes have to close your eyes and say, the hell with it, I'm going with it.
Exactly.
So,
Okay. Do you guys have any thoughts on treasury markets, directions? George is a big treasury guy. Pays attention to most of that stuff. Any spots, any directions?
The market has met. We talked about it last week. We had the potential double bottom in the bond market. We took that out the next day. We had the big reversal on Thursday. Then we had the bullish for treasuries non-farm payroll number. The market rallied and then immediately gave everything up on Friday. And since Thursday and Friday of last week, Tony and I have both been on the same wavelength. You have to be short the credit markets. We've taken out support levels that should have held over the last 2 days. This morning, the 10-year went through 120.24 like it bounced once off of there and then went right back through it. We're seeing consistent new lows in treasuries. From what I see too on the customer side, people are not short yet. We're still just seeing long liquidation in the credit markets. We haven't gotten to the point where people are bearish and more people are short. And until that happens, we will not see a significant low. So,
I've been writing for a couple of weeks that the RSIs are still around 30 in the treasuries. I mean, they're not oversold yet, And on these breaks, we're actually seeing open interest go down. So that's longs liquidating. We don't even have shorts in the market yet. I think you said
yesterday
we
was the
finally,
first day we had a big increase.
We finally had a big
interest.
increase in open interest. So now we finally got a few shorts in the market, but that's nothing. I mean, what I know about markets is they can go down a lot quicker than they can go up. And I've been writing for some time. They all have it. When we're talking about the treasuries, they all have it. When the Fed did their new round of POMO, and they asked the dealers for their offers, and the Fed were buying 7 to 9 million, and the dealers offered them 29 million. It's like, whoa, they've all got it. They don't want any more of it, and it's been one-way traffic ever since. They've been buying back almost every day, and the treasuries go down. They wait, like you say, you wait till that 9:30, 10 o'clock Chicago time area. You let them get their buying done, and then you let them have them again. So
I think the big thing too is today and tomorrow with the auctions.
Yeah.
I think you're going to see if there really is any demand, who the buyers are, and
the buyer's been the Fed.
right. And yesterday, you saw the 3 years, which was pretty bad, and I got to assume if the 3 years are bad because that's where most of the interest is, I think the 10s will be worse, and I think the 30 years will be even worse.
Well, we have backed them up a lot. We got the bonds, 440 this morning, I think, and the 10 years almost to 330, I believe.
Right.
We're getting the levels where I think you're going to bring in some of the sort of the natural buyers, the insurance companies, and those types of guys. But the speculative buyer, the traders, we're not seeing that. The bids from Asia there was rumors of massive selling out of Japan last night. They had a bad bond auction in Japan. Germany had a bond auction that actually didn't get completely sold.
Right.
They're fairly common in Germany where auctions fail like that. We've never had a bond or a note auction fail in the United States. I think we could see something like that, where the Treasury comes out and says, we're going to try and sell 13 billion 10 years, and we only get 10 billion bonds. That could happen. We've never seen that here in my memory, which is pretty old.
And then yesterday there was talk or rumors going around that in 1 to 2 years they're going to be, the U.S. will be downgraded. That's the talk. So, I mean, that's even scarier. But how could they not with that much debt out there?
I hate to say it, but
Yeah.
we have a worse deficit to
Right.
GDP ratio than my homeland of Greece.
I mean, did you see Bernanke on 60 Minutes and the lip was going again?
Right.
It's like, you know, there's another man that's full of shit. You know, I mean, you know,
We
he's
talked,
scared.
we talked about that yesterday with printing the money. So they're not printing money, but come on. I mean, you might not physically be printing the money, but
Right.
you know, you're pumping stuff in. You know, and it's
I have a very dear mate who's nowadays resides in Switzerland, and he's been talking about for a long time, you know, the 10-year with 3%, below 3%. These are historic lows. You have to buy Wall Street. He says, but the tipping point will be 4% when the bulls will start going, okay, let's. And he says at 5%, you can let them have Wall Street. And we've gone through 3%. I just looked on my computer. 3.297 was the high today. The 30-year 4.467. You know, they're going quickly. You know, and you know, I remember the bond market of 93, 94 when that thing came off. You know, they come off. There's you know, never underestimate the power of the bear.
right.
You know, I mean, Wall Street broke 30% in 3 days in 1987. You know, 32%. I mean, that was fun.
Right. All right, let's quickly hit on commodities. We only have a couple minutes, but gold today, huge down day, down $35. Any thoughts on gold, oil? You know, again, only a couple minutes. If you guys just want to hit on that quickly.
Just the chatter that I've heard, and Tony, you might know more about it, but it sounds like there's a lot of key reversals in a lot of commodities. I've heard, guys were talking about cattle yesterday, and gold had it, and it seems like it's kind of across the commodities sector of these reversal get short patterns kind of came in. I don't know if that's true or if that's what you saw too. Or
I know I have a trading system that I developed, and I got sell signals yesterday in gold and in cattle.
okay,
So I'm short the cattle. I didn't sell the gold. I didn't want to sell it in the hole.
right.
Unfortunately, it's now $35. but I am, you know, I'm short some currencies and everything. So
Can I throw out the idea that maybe higher interest rates are affecting the commodities a little bit? There is a cost to holding commodities that is
Right.
dependent on the level
More
of
expensive money.
interest rates, exactly.
And that carry trade too. You
this
know,
is why we invite you, George, because you're really clever.
All right, guys. Well, that was Brian Tehako, George Cavaligos, and Tony LaPorta. Thanks for checking in on us, and hopefully keep looking at our webcast. Thanks.